Hi, welcome back to Marina Teachers for another CAPE Entrepreneurship tutorial video. In today's video, we'll be discussing business valuation, how to calculate it. Don't forget to like, to comment, and to subscribe. You would remember in our last video, we looked at business valuation, what it was, and the reasons why a business would need to be evaluated. So in today's video, we are going to look at 5 different methods of how businesses actually calculate their worth. I know you're probably wondering, so how do we calculate this venture valuation? I mean, its venture valuation is so important to making key financial decisions. So whether you are a business student, CAPE entrepreneurship student, an investor, an entrepreneur, let's continue to look at some methods of calculating venture valuation. Our first method is entry cost valuation. The big question here that we must ask is, what does it cost to build this business? The entry cost valuation estimates the business value by calculating how much it will cost to start this business from scratch. This includes analyzing the cost of recruiting employees, purchasing office machinery and equipment, setting up the office space, product development, marketing and building the brand's reputation, market, and just the overall establishing the company's operations. Investors tend to use the entry cost method to see if buying an existing business is cheaper than starting a similar one from scratch. Now let's discuss some benefits of the entry cost valuation method. Firstly, it reflects current market conditions. So since it is based on the cost of acquiring like new assets, new machinery, new equipment, rent of office space, it would reflect how much you'd have to pay today. So it is a more accurate and up-to-date assessment of the value of the assets or the things that the business owns. Secondly, this method tends to be very objective and reliable. Since it is based on observable market prices, this makes it less prone to subjective judgments. Third benefit is that it is very useful for decision making, and it can also help with budgeting and strategic planning. This is because the business is aware that if they have to purchase new assets or hire new staff or pay for any new expenses, they can cater for how much they will have to spend in the future. A fourth benefit is that it is easy to calculate. That is, if you compare it to some of the other methods that we're going to look at in this video, especially if the information is readily available. Another benefit is that it is useful for replacement decisions. It helps companies to understand the cost of replacing pieces of machinery, equipment, and even employees, or if they should just keep what they have and continue to maintain and service it if it is cheaper. Now, let's look at the disadvantages of the entry cost valuation method. The first disadvantage is market price fluctuation. What this basically means is that the prices of assets can change over time. So it can make this method a bit volatile. The first disadvantage is market price fluctuation. Another disadvantage is that the information that we may need for the valuation of the business may not always be available. This is especially true for certain assets the firm might have, and even the intangible ones for which there is no market equivalent. Another disadvantage is that the entry cost valuation method doesn't really take depreciation, which is the cost of the wear and tear of the asset due to its usage, into consideration, like some of the other methods like the net book value method. Another disadvantage is that the price of acquiring a new asset does not always represent the true economic value of the asset that is being used currently in the business. Another disadvantage is that this method is not suitable for all assets, such as the intangible ones and highly customized or specialized equipment or employees. Our second venture valuation method is the asset based approach. The question that the business asked at this point is, how much are your assets or the things which you own worth? How are we going to measure that? The asset based approach focuses on everything that the business owns. Its tangible assets, such as the warehouse full of inventory, the office equipment, machinery, vehicles, to the intangible assets, such as the patents or trademarks or goodwill, brand reputation. Now, let's quickly discuss some advantages of using this method. Now let's quickly discuss. Firstly, it is relatively simple and objective, especially when compared with the other methods, since it is based on information derived from the financial statements, which makes it easy to calculate. This approach is also commonly used by businesses who own a lot of assets, such as construction companies, manufacturing firms, and even real estate firms. The asset based approach also provides a minimum value, which means it acts as a floor valuation, ensuring that the business is going to be valued at, for a minimum, the worth of its assets. Another advantage is that this method is good for liquidation scenarios. So, in the event that the business is dissolved and they need to sell their assets, at least the shareholders will know the worth of the business and how much you will get for the sale of the assets. Now, let's get into the disadvantages of the asset based approach. The first disadvantage that we're going to look at is that it ignores future earning potential. And we'll learn a little bit later on in the video, so stick around for that. But as a result of this, it also does not consider factors such as revenue growth, profitability, or the intangible value of assets such as your brand reputation. Another shortcoming of this method is that it is not suitable for all types of business. So, if a business has very few physical assets, such as a tech firm, a consultancy, travel agency, a knowledge based type of business, then it may appear to be undervalued because this one looks at the value of your physical assets. Another shortcoming of this method is that assets are usually recorded at historical cost or the price at which we obtain these assets. And this may be a shortfall because it does not really reflect the current market value as we would have seen in the previous type of method of valuation. Another drawback is that this method does not fully capture the value of goodwill, intellectual property, and other non physical assets that the business may own that contribute to a company's success. Therefore, the intangibles are usually very undervalued. Okay, so just to review, the asset based approach measures the business's worth in assets. So it works really well for asset based businesses, but it may undervalue businesses with few assets, and it doesn't take into consideration the future earning potential and the value of the intangibles that are owned by the business, which contribute to the business's success. This brings us to our third venture valuation method, the net book value or the book value method. So, the book value method is probably one that you're most familiar with because it is an accounting measure that values the business based on the assets minus depreciation, amortization, and liabilities to give you that book value figure. This method is used especially in financial reporting and accounting and is used to record the value of the asset, but it is also helpful in assessing liquidity and financial stability of the business. Now let's consider some advantages of this method. Now let's consider. Similar to the asset-based approach, this method is relatively simple and it is objective. Because it is based on recorded data, it is simpler to calculate, and it is also not subjected to changing market conditions. Additionally, it is also good for asset-rich companies. Additionally, this method is both stable and reliable because book values do not fluctuate as market values do. Most importantly, this method is a benchmark for investors who look at the financial statements, namely the balance sheet, to see whether the company's stock is over or undervalued. Now, let's look at some disadvantages of this method, which are also similar to the asset based approach. So, some of the major disadvantages are that it ignores market conditions, it's not suitable for service based businesses, and it does not reflect the value of intangible assets. Additionally, book value can be impacted by subjective accounting policies such as the depreciation method and asset revaluations. So, if a business uses, for instance, the reducing balance method versus a straight line method for depreciation, it can impact the net book value. Our fourth method is the price earnings multiple or the price earnings ratio. So investors tend to use this method to evaluate the business based on its profits. Our fourth method is the price earnings multiple or the price earnings ratio. Earnings are important because it measures the profitability of the business. The price earnings ratio shows the expectations of the market and the price that you must pay per unit of the current earnings. To calculate its formula, we divide the share price by the earnings per share to give us a price earnings ratio. Now let's try this example together. Our friend Sam wants to invest in either company A or company B. Now, if he looks at company A, the share price is $60, so that might seem to be a better company because a higher price usually is a reflection of the quality, right? Maybe. But he wants to be prudent, so he's going to use the price earnings multiple. When he looked at the earnings per share, Company A's earnings is $20 and Company B's earnings are $10. So, if you were to divide the share price by the earnings price, the price earnings ratio for Company A is 3 to 1 and for Company B is 5 to 1. Which one do you think that Sam should invest in? If you said that Sam should choose company B, you are correct because a venture with a higher price earnings ratio is favorable to investors because it shows that the company is not only profitable now, but the investors can also expect future earnings growth, and therefore they are more willing to invest or pay more for the company's stocks. Now let's get into some benefits of the price earnings ratio as a method of venture valuation. So firstly, the formula is pretty straightforward, simple, easy to calculate and use, which makes this an accessible tool for the investors. Secondly, it might be easier to compare companies since this method standardizes the prices of stocks and the earnings. The third advantage is that it provides a snapshot of the company's growth and profitability. Remember that a high price earnings ratio may indicate a strong future earnings growth, while a lower one may indicate undervaluation, and investors are more likely to invest in companies with a higher price earnings ratio. A fourth advantage is that it guides investment decisions. An investor may look at the price earnings ratio to decide if it's worth buying these stocks of the company because of its in earning power. Additionally, this method is most suited for companies whose stocks are publicly traded on the stock exchange. Now let's look at the disadvantages of this method. This method ignores the debt service ratio or debt levels in general, which can significantly impact the organization's financial health. It is also not useful for companies with negative earnings. This method also doesn't account for the growth rate, although its figures can indicate if the company can expect growth or if it is being undervalued. Another disadvantage is that it may be impacted by accounting policies, such as how a company recognizes its revenues and expenses, thus making it difficult to compare between different companies. Now let's get into our last method for today's video, the discounted cash flow. The discounted cash flow method estimates how much a business is worth today based on its expected future earnings. So, in case you're wondering why this is important, just think for a minute that if you're going to the supermarket today with $100, you are able to buy fewer items with that money than you would have been able to buy 10 years ago in the supermarket. And you would be able to buy even fewer items 5, 6 years from now. This is because a dollar today is simply not worth the same as a dollar 5, 6 years from now. So, to account for that, that is why businesses use the discounted cash flow method to figure out how much would you be able to purchase for that same amount of money today 5 years from now. So the formula to calculate discounted cash flow is equal to your cash flows for the year 1 divided by 1 plus the discounted rate to the power of 1, as it's the first year, plus the cash flows for the second year over 1 plus the same rate to the power of 2, plus the cash flow of the third year or the fourth year. Just keep going until you have to find the discounted cash flow for the number of years. So let's look at this quick example. So let's just say this business is estimated to generate $10 million in revenues or cash flows for the next 10 years. If we want to find out how much that $10 million can buy you or what it is worth, we'd have to apply the discounted cash flow method. So after year one, that $1,000,000 would be able to buy approximately $952,381 of goods that we would purchase for $1,000,000 today. So you can see that is at least $50,000 difference in the value of the money after year one. After year two, that same $1,000,000 is going to buy you $907,029 worth of goods. In year three, the business expects to pick up, so they generate $4 million. But when we discount that, we will see that $4 million in 3 years' time will be able to buy you the equivalent of today that you would have to spend $345,350. That is over $500,000 difference in the value of the money just 3 years from now if you're using a discount rate of 5%. After year four, that same $4 million is going to be worth $3,290,810. That means that same $4 million is going to have a difference of approximately $800,000 in terms of what you're going to be able to buy 4 years from now. Now, let's discuss some benefits to using the discounted cash flow method for venture valuation. So the first major advantage of this method is that it takes into consideration the future value of the money. Unlike the asset-based approach and the net book value approach, which we looked at earlier, those two focus on the historical cost, but this looks at the future earnings and the worth of that money. Another advantage is that this method is independent of all market conditions. So it does not have to rely on comparable companies, and this works well, especially when you have unique businesses. Another example is the flexibility of this method. This method can be applied to various businesses across industries, regardless of the number of assets it either has or doesn't have, unlike some of the other methods in this video. Another important advantage is that it places emphasis on the time value of money. So it is very important to consider that the money that you're going to make in the future will actually be able to buy you less items. This is important to help the decision makers become more prudent in their strategy for the business. Another advantage is that this method is particularly useful for startups and high growth businesses. This is because it is both comprehensive and realistic, especially when these companies are trying to predict their future income earnings. Now let's look at the disadvantages of this method. The first disadvantage is that, unlike some of the other methods, this can be quite complicated as well as data intensive. You need to have detailed financial modeling, which makes it more difficult to apply compared to the simpler valuation methods. The second disadvantage is that this method is highly dependent on assumptions. Therefore, small changes in the discount rate, the growth rate, or cash flow projections can actually significantly impact the valuation of the business. Another disadvantage of this method is that it is actually quite difficult for unstable businesses and some startups to consistently and accurately predict their cash flows, which they would need for the proper valuation of the business. So now we're almost at the end of the video, so stay with me. Let's just recap this. Remember that the discounted cash flow method takes into consideration the future value of the money, and it is quite helpful for startups and high growth businesses, as well as is businesses with steady projected revenue. However, if businesses are uncertain about their future revenue, it might be a bit risky. And small changes in any of the assumptions used to calculate this can lead to great variances in the valuation of the business. So let's recap this video. In today's video, we looked at the five major venture valuation methods. We looked at some of the uses as well as the advantages and disadvantages of each method. Comment down in the description box below your key takeaways from this video. So as we conclude, let us remember that there are multiple ways to value a business. Each venture valuation method has its benefits and its drawbacks. Asset based methods work well for established business, especially those which own lots of physical assets. The price earning ratio helps investors compare businesses, and startups often rely on the discounted cash flow method for long term growth predictions. So, now that you understand these methods, do you think you can make up different scenarios for each method? Try it. Let us know in the comments. Also, if you have any other questions for me, feel free to type them in the comments below. Thanks for watching. Don't forget to like and to subscribe and to share this video. Stay tuned for more CAPE Entrepreneurship tutorials from Marina Teachers. Bye for now.